Today, the rate hike cycle endgame. Hi again, it's Martin North from Digital Finance Analytics. Well, I've noticed post covering finance and prime news with a distinctively Australian flavour. Well, the Federal Reserve yesterday lifted by 25 basis points, and the Bank of England raised its key interest rate by another 50 basis points on Thursday, warning that its battle against inflation isn't over, but dropped a pledge to keep increasing them forcibly if needed. And they said inflation had probably peaked, sending the pound to session lows in volatile trading. The move, which was as expected by financial markets, takes the bank rate in the UK to 4%. That's the highest it's been since 2008. That was, of course, since the financial crisis. The bank's calculations show that current market expectations of a peak in rates of around 4.5% in the middle of 2023, that would put inflation below its 2% target in the medium term. And it suggests it doesn't need to raise the bank rate that much more, if at all, although it was careful to add that uncertainties around the outlook are high and that risks to inflation are skewed significantly to the upside.
Welcome to the February Monetary Policy Report press conference. Today we've increased bank rate by 0.5 percentage points to 4%. So obviously I want to start by explaining why we've done this. And I'm going to start with the outlook for inflation. Since the November Monetary Policy Report, we've seen the first signs that inflation has turned the corner. Annual consumer price inflation has come down from 11.1% in October to 10.5% in December. That's below where we thought it would be in the November report. And we think it will continue to fall this year and more rapidly in the second half of the year. This has a lot to do with energy prices. Last year's very large increases are now beginning to drop out of the annual calculation of the Consumer Price Index. Moreover, wholesale gas spot prices have fallen by around 50% since November, and gas future prices have also come down markedly. The chart that's come up shows the MPC's central projection for inflation, which is conditional on a market-implied path for bank rate that peaks at around 4.5% by the middle of this year. In the central projection, consumer price inflation falls to around 4% towards the end of the year.
We have done a lot on rates already, and the full effects are still to come through, Governor Andrew Bailey said in opening remarks at his regular press conference. One last 25 basis point hike in bank rate in the March meeting still can't be ruled out. But if, as we expect, signs of slowing price rises and accumulating labour market slack continues to emerge in line with expectations, then the Monetary Policy Committee looks set to keep bank rate at 4% in March and throughout the rest of this year, said Pantheon macroeconomic analyst Samuel Toombs in a note to clients. UK markets reacted strongly to the bank's guidance, which was the clearest signal yet that it's approaching the end of its tightening cycle. By raising the cost of mortgages and consumer credit, the bank threatens to sharpen an already clear economic downturn in the UK. In fact, the International Monetary Fund expects the UK to be the only G7 economy that will shrink this year, and household spending has already showed signs of slowing at the end of last year. However, it's been forced to keep raising interest rates because inflation is also running higher than in the US or the rest of Europe, and at 10.5% in December hasn't come down as quickly as it has elsewhere. Headline CPI inflation has begun to edge back and is likely to fall sharply over the rest of the year as a result of past movements in energy and other goods prices, the bank said in a statement accompanying the decisions. However, the labour market remains tight and domestic price and wage pressures have been stronger than expected, suggesting risks of greater persistence in underlying inflation. That judgment comes a day after the most widespread strikes in Britain for over a decade, with civil servants, teachers and other public sector employees all pressing for higher pay. As a result of the improved inflation outlook, benchmark natural gas futures in particular have fallen by 50% Since the bank's last inflation report in November, the bank dropped from its statements a promise to act forcibly to bring inflation down further if it needs to. As at December, the Monetary Policy Committee was not unanimous in its decision, though, with 2 from the 9 members voting for no change in the bank rate. The pound was down quite significantly, while the yield on the 10-year gilt dropped a little as well, its lowest, in fact, in nearly 2 months. The UK-focused FTSE 250 stock index did rise about 2.5%, which is its highest since last August. Now among analysts, Danielle Andrichui, chief economist from Quintet Private Bank in London, said there's still some risk that the bank could go for further interest rate rises if inflation news was more unfavourable. After all, the committee still sees risks to the inflation outlook as skewed to the upside. That said, today's decision raises the possibility that the bank rate may have already peaked or be close to peaking, undershooting the 4.5% level priced in by financial markets prior to this announcement. Wes McCoy, Senior Investment Director at Standard Life, said, "When you read the commentary around the rate hikes, the Bank of England seemed more hawkish. It's still more concerned about inflation. The language around it was a 50 basis point rise, but also around that they still need to stay on the pressure against inflation, whereas the interpretation from the US overnight was there are reasons to step away from that pressure." Dean Turner, the chief Eurozone and UK economist with UBS, said, "As expected, today's 50 basis point hike was a split decision. It looks as though the appetite for further outsized hikes is fading, but given the Bank of England's revised outlook for growth and inflation, this hiking cycle is unlikely to be over just yet. We look for one further increase of 25 basis points in March, which should mark the top of the cycle. Furthermore, we believe the door remains open for rate cuts before the year is out." Michael Brown, market strategy with TraderX in London, said the move in the pound was the vote split. "I think market participants were expecting at least one to go for a more modest 25 basis points, and that may have been one of the reasons why we saw cable come off. They dropped forcibly out of the language. That pretty much nails on the fact that March is probably going to be the last rate hike, and of course the longer run inflation forecasts have come quite sharply lower as well. So it's a bit more surprising in terms of votes, a bit more hawkish than we'd expected, but everything else is pretty much in line, mostly implying that the old lady is very, very close to the end in terms of raising rates." And meanwhile, the ECB confirmed its December decision to wind down its asset purchase programme by €15 billion per month, on average, from the beginning of March until the end of June 2023. Lagarde has previously said that inflation in the Eurozone is way too high, although data this week has helped to fuel investor hopes that those cost of living pressures may be beginning to ease. Price growth in the Eurozone slowed by more than expected in January, according to figures from the European Union Statistics Agency, as a mild winter supported an easing in monthly energy cost increases. The bloc's economy has also proved broadly resilient to the pressures brought on by the higher borrowing costs. The Eurozone unexpectedly grew in the fourth quarter, defying expectations that the ECB's aggressive rate hikes in 2022 would spark a deep recession in the near term. But quarter-on-quarter growth in the final 3 months of 2022 was only a slight 0.1%, while the headline inflation reading of 8.5% last month is still well above the ECB's 2% target. Meanwhile, a technical problem at Germany's Statistics Office meant that the currency area's January Consumer Price Index did not include official preliminary data from its biggest economy. Analysts at ING also predicted the ECB will continue to hike rates as long as core inflation in the Eurozone remains stubbornly high. The measure, which strips volatile items like food and energy, was unchanged at 5.2% year-on-year in January. And ECB members will have a chance to pass through further inflation numbers before they make their next policy decision on March the 16th, with officials keen to learn more about how much price growth is deaccelerating. Media reports have suggested that support around a smaller rate rise could be starting to gain traction. Speaking to reporters, Lagarde said that there was a very, very large consensus around increasing borrowing costs by 50 basis points today and again at its March 16th meeting. But Lagarde denied speculation that the ECB will be finished raising rates beyond its next gathering. We know that we have ground to cover. We know that we are not done, Lagarde said. She added that as we receive projections, we will need to assess what rates, what level, at what pace will be needed to ensure that inflation cools down to 2%. Of course, the move from the ECB comes after the Federal Reserve pumped the brakes on a period of unprecedented policy tightening on Wednesday, raising the borrowing cost there by just a more modest 25 basis points. But the Fed Chair Jerome Powell warned that ongoing increases will be required to help control inflation. Now, over in the US, the Dow closed flat on Thursday as investors piled in on tech stocks following a rally in Meta, though weakness in healthcare and energy weighed on upside momentum. The Dow Jones Industrial Average fell 0.1%, the Nasdaq was up 3%, and the S&P 500 rose 1.4%. Meta reported fourth quarter revenue that topped estimates and announced a $40 billion share buyback program, sending its shares more than 23% higher. Sentiment on the stock was further boosted after Chief Executive Mark Zuckerberg detailed plans including flattening the organization's structure to make the firm more efficient. The focus on efficiency was welcomed by Wall Street after the firm spent billions in investments to support engagement following the hit from Apple's privacy-related changes to its mobile operating system, iOS. The transitions had been painful for investors, and while it's too early to declare victory, early evidence from Zuckerberg's pivot appears to be bearing fruit, Deutsche Bank said, as it hiked its price target on the stock to $200 from $125. Other big tech stocks, including Apple, Amazon, and Alphabet, all of which report quarterly results after market close, rallied. And by the way, it looks as though Apple missed. As well as earnings from Meta, sentiment on tech was also helped by renewed confidence that the Federal Reserve will end rate hikes sooner rather than later, after downshifting to a quarter-point rate hike on Wednesday. The rates market is now implying a peak funds rate of 4.88%, which means just one more hike, likely followed by a May pause, Jeffries said in the note. Tesla added to its recent rally, rising more than 3% as clouds hanging over demand in China appear to be departing, somewhat following a Reuters report that the company will lift output at its Shanghai factory to nearly 20,000 vehicles per week for February and March. The surging growth corners of the market include tech and consumer discretionary, appeared to come at the expense of value sectors as energy and healthcare stocks fell. Energy fell nearly 3% as gains in oil prices were kept in check by a stronger dollar and ongoing jitters about higher energy production from Russia. Healthcare, meanwhile, was also pressurized by a slump in Eli Lilly after the drug maker missed fourth quarter revenue estimates amid weaker sales in its lung cancer drug and the impact of a stronger dollar. Honeywell International also delivered mixed quarterly results as revenue fell short of estimates, though its shares paid losses to trade flat. And in other news, Coinbase jumped an amazing 24% after a class action suit alleging the crypto exchange sold unregistered securities on its platforms was dismissed. So you can see here that the US lifted by 25 basis points, the UK lifted by 50 basis points, and the ECB lifted by 50, and the analysts are saying we're close to the end, which of course then begs the question, what will the Reserve Bank do on Tuesday? I still believe 25 basis points is absolutely locked in, but there is speculation from some quarters they might go a bit more aggressively than that, simply because inflation in Australia has yet to peak, and there are very few signs of it easing back, at least in the short term. So perhaps there's a lag here in Australia relative to what's happening in some countries overseas. I guess we'll know next Tuesday. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.